Hello and welcome back. This is Scott. This week we're going to talk about income inequality and poverty. So we're going to try and figure out just what is poverty? How do we define poverty? What's the income inequality look like between men and women and different races and backgrounds? And how would we plot it? And how do we know if it's improving or getting more unequal? And why do we think that some equality or more equality may be a good thing? So in order for us to look at inequality, we need some data. Is it getting better? Or is it getting worse? More equal? More unequal? What's happening? Our data is going to be coming from the U.S. tax returns. Now, with that comes some good things and bad things. Typically, they're audited, so we generally believe that they're pretty close to accurate. The bad thing is that tax returns are done at the household level. In my family, there's myself, my wife, and kids. That is going to be different than when I was single. The number of people in each household aren't equal. So we're going to be looking at household inequality over time. Okay, so how are we going to measure household inequality? What we're going to do is we're going to organize all the tax returns in the U.S. And we're going to organize them from the poorest household in America to the richest household. And then what we're going to do is we're going to divide up each household into fifths. The lowest quintile, the richest quintile, and the middle three quintiles. So the middle three are generally called the middle class, the lowest is called the poor, and the richest is called the rich. And what we're going to do is we're going to look at how these quintiles change over time. Okay, so now that we have all of these quintiles, what we're going to do is we're going to see what percentage of GDP, or the total amount of goods and services that an economy can produce, are distributed where. So the lowest 20% of households, the lowest fifth, brought in 3.1% of what the U.S. economy made in 2015. The richest 20% of households brought in 51%. So that difference right there, 15 to 18 times, these people have 15 to 18 times the resources as those over there. So then the question may be, well, how is this changing over time? So what we're going to do is we're going to look at the baseline, which is 1967, and look at 2015. And what you'll notice is that between 1967 and 2015, the poor is now bringing in a smaller fraction of the economy. They used to bring in 4% of the total economy. Now they're bringing in less. The second poorest is bringing in less. The next middle class is bringing in less. The second richest class is bringing in less. So the only group that is doing better, that's bringing in a bigger percentage, is the richest 20% of incomes. So we're starting to see this distribution, and we're starting to see how this changes over time. Economists are going to use these numbers. These numbers are the same ones that were on the previous graphs. So one of the things we're going to have is just how much of the income was earned by each percentage. So those are the same numbers that we had before. And then what we're going to have is cumulative. A cumulative is just how much money was made up into that point. So if I said the poorest 20% earned 4%, how much did the poorest 40% earn? Well, the poorest 40% would earn, you would add those two together, so it'd be 14.8. Then we'd say, how much did the poorest 60% earn? So it'd be that plus that plus that would be 32%. How much did the poorest 80% earn? It would be these first four boxes, 56.3. And how much did the poorest 100%? Well, that should always be 100%. Sometimes we get some rounding errors, but it should be close to 100%. Same logic on 2015. We could look at it. How much did each 20% make, or how much did they make up to that point? So again, this 11.3 is the sum of these two numbers. 25.6 is the sum of these numbers. 44.8 is the sum of these four numbers. And 100% is the sum of all five of those numbers. Then what we're going to get into is perfect equality. Well, what would equality look like? Well, 20% of households would have 20% of incomes. The next 20% of households would have 20% of incomes. The next 20% of households would have 20% of incomes. The next 20% would have 20%. Think about it if I asked it in a cumulative form. If I said, if you are looking at equal distribution of income across households, how much income would the poorest 40% have? Because cumulative is the amount of the top two, the top 20% here and the next 20%. So 40% of households would have 40% of income. 60% of households in equality would have 60% of incomes. 80% of households would have 80% of income. And 100% of households would have 100%. Then we could talk about what would perfect inequality look like. And perfect inequality would mean that no one has anything until the last person has everything. So nothing, 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 100. Well, if I add up and accumulate 0, 0, 0, 0, and that would be 100. What we're going to do is we're going to graph this in a little bit. If we're going to be graphing and drawing about these, what's equal income distribution look like and what does unequal distribution look like? Does that really tell the whole story? In other words, are there some biases within these household categorizations? And the answer is yes, there's some really dramatic biases in these categories. categories. So for example, we're talking about households here. Well, households aren't of equal size. The lowest fifth household only has about 1.8 persons per household, whereas the upper income households have 3.2 people per household. Well, why is that significant? Well, if you take a single person just out of college, they may only have one income. Whereas if you take a newly married couple out of college, you suddenly double their income. They're going to be making more per household than someone who's single. So we have some distribution counts problems on just the number of people that are making up each household. Also, the average ages differ substantially by each quintile. So the next slide, we'll talk about the income distribution and income life cycle. And we would expect people to be at different points in their life earning different amounts of income. So what do we mean by income life cycle? Well, if we just simply draw out income and we talk about time, you're a kid, you're earning no money, and then you start babysitting and you get your first part-time job and then your first job out of college and your pre-income and your max career, your experienced career, and then pre-retirement you start earning less, and then as you get into retirement you earn a lot less. Over time your income varies, and depending on how many people are in which bucket, that could be another source of bias. And we know that the average age in each bucket is not identical. So we're not randomly picking people. People are getting filtered and put into different boxes. So if we're going to talk about income, we need to talk about what individual income is and what household income is. Household income is just the sum of the different individuals in that household. Okay, that makes sense. Well, what's individual income? Individual income is your labor income, so that's your salary from working, if you are working. Your asset income, so that's if you have investments on savings or property or stocks or bonds, you could be making some money. There are transfer payments, so Social Security and other types of welfare that is money given to you not because you are working, they're just an exchange. And then finally, the negative is taxes. So you may be earning some money but not able to keep it all because you give some to the government for their redistribution or their spending. Which brings up, what's the main mechanism government uses to try to redistribute income and remove some of the inequality? And it's pretty obvious. They theoretically tax from the rich and then they transfer it over to the poor in terms of supplementing education or housing or all sorts of other food stamp projects. And that's the mechanism they use to try to offset some income inequality. Now you'll notice in the income definition, what was missing there was called in-kind transfers. An in-kind transfer is where the government gives you something, but it's not cash, so it doesn't count as income. Let's say we give you government cheese, or we give you government housing, or we give you some other type of good or service. That actually makes you better off, but it's not included in this income distribution. So what that means is that the poor is the amount of inequalities actually being exaggerated in this situation. Because if you're really poor, there are some other supplements that are improving your lifestyle and your life standard of living, even if it's not being counted in as income. How are we going to measure inequality? Well, one thing we're going to do is we're going to graph inequality. We're going to graph on the x-axis the cumulative percentage of households, and on the y-axis the cumulative percentage of income. And what we're going to do is we're going to draw this Lorenz curve to see the distribution of income across an economy. So what do we mean? The cumulative percentage of households is going to be on the x-axis, as I said, and the cumulative percentage of income is going to be on the y-axis. And this line right here has to be perfect equality. Why? We'd expect 20% of the households to earn 20% of the income. We'd expect 40% of the households to earn 40% of the income if it was perfectly equal. This line tells us how the income is actually being distributed. Well, what would we expect for perfect inequality? Perfect inequality would be no one would have any income, no income, no income, no income, no income, until the last person, and then they would have a lot of income. So the closer we get to, the more this line bows, the more it gets pulled that way, the more inequality we have. The less it bows, the more it gets closer to this line of equality, we have more equality. So this is how the Lorenz curve is going to visually show us how much equality or inequality exists within an economy. So this is just a graph of the Lorenz curve, which maps out in 1967 that 4% of households, so the orange line, 20% of households had 4% of the money. The second poorest, so 40% of households had about 14 or 15% of the money. Then we have the middle had about 32% of the money. The second richest had 56% of the money, and the richest had 100%. Here's what I want you to look at, is if you look at 1967, which is the orange line, and the blue line is 2015, if we move closer this way, we're getting more equal. If we're moving closer this way, we're closer to the line of perfect inequality. We're getting more unequal, more inequality in the economy. And you could see that as this orange line is moving to the right, we are increasing in inequality. And that's consistent with what we saw earlier. So economists like to have a single number, and that single number to measure inequality is called the Gini coefficient. And what the Gini coefficient is the amount of space between the line of perfect equality and the Lorenz curve, so that little space right there, out of the total amount of space that is possible for inequality, so that triangle right there. So if you have perfect inequality, you'd have this blue triangle divided by a blue triangle, you'd have inequality of 1. If you had perfect equality, you'd be looking at the line space between this line of perfect equality and that same line of perfect equality. There'd be no gap. So it'd be that 0 gap divided by the triangle, you'd have 0. So what we're going to try and look at is how does that equality measure work? And we can look at the Gini coefficient of the US over time. And that Gini coefficient is slightly increasing more and more, and that allows us to understand more how equality is working and changing over time. So there are a couple weaknesses with the Gini coefficient by using it by itself. These two Lorenz curves produce an identical Gini coefficient. So you really don't know about the particular share of income within any quintile, you just know about the overall share. The other thing that you don't know is in curve 1 or curve 2, how big are those pies being shared? Perhaps curve 2, one of them is sharing $1 million of GDP, and the other is sharing $1 trillion of GDP. You don't know how big the pie is. You only know about the distribution. So that brings us to, well, why does inequality exist? And there are several reasons that are reasonable. So there are some people that have innate abilities or skills. So Michael Jordan was a much more talented basketball player than I am. There are lots of gorgeous models. They have some gifts that I just don't have. As a result, they're able to make more money. There's also choices of work and leisure. So I have multiple jobs. I work really hard. By having multiple jobs, I earn more income than a good friend of mine who really values leisure. And when he values leisure, he doesn't work as much. He does a lot more hiking and does other stuff. He's making that choice to give up some income to do some other things. That's reasonable. Education. The more education, human training you have, the more human capital you have, the more productive you are, the more valuable you are to a certain company, the more you're going to get paid. That makes sense. So differences in education. Risk taking. So if you are a risk taker and willing to start your own company and willing to take risks, you're more likely to end up in one of the tails. Your company will either be very successful or be very unsuccessful. And you're going to be in more of the extremes. That makes sense. There's some things like luck. So maybe you bought a lottery ticket and you won. Nothing explains that other than luck. The final one is wage discrimination. And wage discrimination is where we believe that people of equal skills and equal productivity are getting paid differently for some other characteristic. So we want to talk about that a minute. Here's a question for you. So let's say two workers have identical jobs and job titles. So they're both car salesmen. Should they be paid identically? When I ask this in my face-to-face class, I will get about 80% of the students who will immediately say they have the same job, they should be paid exactly the same. And economists don't believe that to be true. If I take a friend of mine who's a very good salesperson, or you take me who would be an awful salesman, the value to the company would be very different. Why? If one person could make one sale a day, that salesperson would be worth more than me, who may be able to make one sale a month. The value of the salesperson is the value of their output. So economists believe that people should be paid according to the value of their output. If you're not being paid according to the value of their output, then we think there's something else going on. So let's talk about what kind of discrimination we're seeing. Since World War I, sometimes we see it World War II, sometimes World War I, African Americans have been earning about 60% of what whites have been earning. Females have only been earning about 60% of males. So if you are an African American female, you're getting hit with a double whammy here. Some of this can absolutely be explained by some of the choices in jobs and education and ages and productivity that we're seeing among these different groups. But some of it cannot. So what do we mean? Well, women sometimes select jobs such as caregivers, early childhood education that don't pay as well as other professions. However, when we standardize for that and when we account for that and when we look in one particular industry and we look at one field and we look at how much experience you have and how much training you have, we are still seeing differences that can't be explained based on age, gender, productivity, training, or any of those other factors. And what we're left with thinking is that there's got to be something else. And the only thing that seems to describe it is discrimination between different races and genders. So let's talk about what we're seeing there. So while many of us say we're against discrimination, it's surprising to think about how often we actually do discriminate. One thing that I often ask my face-to-face classes is, what do you think about the Buy American campaign? Buy from the US. And most people are strongly for it. But if you think about what discrimination is, at least at the grand level, it's about discriminating against a particular class of people or origin based on something that they can't control. Maybe we're judging something that's made in China rather than based on the price or the quality. So if you're not judging it based on price or quality and basing it purely based on origin, to me, that's something that China can't compete on. I have a hard time thinking that discrimination only occurs from the hiring party. Buyers do it as well. And I just think that's important to note. If you think about what a tariff is basically saying we want people to buy in the US. We don't want people to buy abroad. Well, again, what is that discriminating against? Just something to think about. What has been the traditional viewpoint for economists to talk about discrimination? One of them has been, let the free market work. If there's true discrimination, there are a couple things that will happen. One is, if I choose to discriminate against a certain part of the population, what's going to happen? Well, I'm going to avoid some population, and I'm only going to hire white males. And white males are more expensive. And if they're more expensive, then my costs are going to be higher than someone who hires African Americans, Hispanic, Asian women. Eventually, what would happen is those who are discriminating would have higher costs, those who are not discriminating would have lower costs, and they'd be able to make more profits and eventually lower the price and force me out of business. And that has really been the approach of the free market economists for a really long time. Theoretically, that should work. But what's been the problem with that? The problem with that has been, this discrimination has been going on for generations now. While the gap has been closing, that gap still exists. How much longer do we want to wait and tell people, don't worry, eventually discrimination will end because the market is going to put pressure on it? As a white male, I sort of feel hard to say, just wait a little bit longer. If I was a female or African American or Hispanic or someone earning substantially less, and this has been going on for generations, it just doesn't feel like I feel fair to wait. Now, if the market was going to react quickly and it was only going to take 3 months for this to respond and legislation would have taken a year, I'd say, okay, I understand waiting because the cost is too long. But at some point, it's the waiting forever for the long run. In the long run, we're all dead. We got to come up with something. Which brings us to, how well has the market been working? When women really entered the labor market, and I'm going to say that sort of occurred after World War II, there were several changes that occurred, and we could talk about those. But women kept getting promoted and doing well until they'd hit what was called the glass ceiling. And the glass ceiling was this invisible barrier that women would get promoted and then just not be able to get past. One of the things that happened is women hitting this glass ceiling finally said, forget it, I'm going to start my own company. And more women started new companies in the last 2 to 3 decades than men. And why is that substantial? Women-run organizations are very unlikely to discriminate against women. In that case, the glass ceiling is starting to shatter, starting to show some cracks. What do I expect to happen for African Americans and Hispanics? They are sort of hitting their own equivalent glass ceiling. And what you're starting to see now is more and more small businesses are being opened by African Americans and Hispanics than by whites. Why? Whenever they're being discriminated against or people are being discriminated against, if there's a way to get around that discrimination, that is the free market at work. So let's talk about poverty for a second. So if we're going to talk about this income inequality, eventually the line comes of what is poor? What does it mean to be poor? And we have 2 different ways we can define poverty. One is a relative form of poverty. So if we take the whole population and just say, if you're in the bottom 10%, you're poor. Or bottom 20%, you're poor. That's like what we did with the quintiles. And that's a relative fashion. Or we could say, all right, let's look at everyone. And if you earn less than a certain amount, you're poor. And that's absolute. And there's some advantages and disadvantages to both. So the first one was relative. If we look at the bottom 10%, there's one strength, which is it's really easy to define. But there are a couple weaknesses. The first is, if your goal is to eliminate poverty, you're never going to get rid of poverty. Just like if I line up the classroom and say, I'm going to consider people who are short to be the bottom 10%. Even if I take the bottom 10% and kick them out of the classroom, they'll be the next bottom 10%. You'll always have the relative poorest or relatively short 10%. So that doesn't help. Also, if you're looking looking at Beverly Hills, the bottom 10% of Beverly Hills is probably not going to be considered poor by anyone else. So then what we get to is an absolute definition of poverty. An absolute definition of poverty has some positives. One is you could say, you know what, if the poorest person in Beverly Hills is making $1 million a year, you would say, yeah, you're relatively poor, but none of us would consider you in poverty. We could eliminate poverty, and if we're going to have a war on poverty, we have some target to get everyone above. The problem becomes is, well, how do you define this number? If that number isn't correct, well, then it's not clear what poverty is. So we had that number for poverty, and it was 26,000 something in 2016. How did they come up with that number? Well, in 1964, they had a woman from the Social Security Administration do an analysis. And she was very, very bright. And what she looked at, she did a survey of the whole population, or a large portion of the population, and found that there was this number that kept coming up. That households typically spend a third of their income on food. That even if you're rich or poor to some degree, that you're going to be spending this third of money on food. And what they did was they said, well, how much money would it take for you to live and meet the minimal nutritional intake? So if there's a certain amount of protein I need to have, a certain amount of calcium, a certain amount of whatever, how would I get that as efficiently as I can? Notice what I said, as efficiently as I can. So I'm not eating steak, I'm probably eating beans because they have protein. Then we're going to figure out how much it costs me, and we're going to multiply it by 3 to get that poverty line. So this poverty line is then created in 1964, and every single year based on poverty, it gets adjusted for inflation, but it hasn't ever been rebased. And I'll talk about what that rebasing is in a second. But generally speaking, if I look at what a household bought in 1964 and what a household needs today, they're dramatically different. A household in 1964 didn't need internet or computer to help educate their kids. I would argue that's pretty much a necessity now. If you want your kids to be able to be a productive member of society, they have to have that access. So if we're going to look at how many people are in poverty, just so you know, in 2014, about 15% of the U.S. population was living below that threshold. That threshold changes based on the number of people you have in your family as well. How does this number break down? $24,300 for a family of 4 annually. Remember we said we expect a third of that money to go for food. If a third of the money goes for food, you have $8,100 dedicated for food for 4 people. If you take that and divide it by person, you have about $2,000 per person per year. If you take that and divide it by 365, each person gets $5.55 per day for food. If you have 3 meals and no snacks whatsoever, you are averaging $1.85 per person per meal. Now, yes, I understand McDonald's has a dollar value, dollar meal, but you can't live on that forever. And let's say you're really hungry or your kid want milk or it's a birthday and you want to have a birthday cake. It's got to come from somewhere else. But it's this level of intensity has also been applied for everything else. So if $8,100 went for food, that means that $16,200 went for all your other necessities. Now for a family of 4, let's say you spend $800 a month on rent for a family of 4. That means you're spending 800 times 12 on rent, which leaves $6,600 for everything else. That $6,600 is $1,615 a person. But remember, you still need water, electricity, heat, transportation, medical, education, clothing, entertainment, technology. You have all these other expenses for a family of 4 with about $6,600. Good luck doing that. I think that's an unbelievably tough challenge that I wouldn't want to be faced with. We want to talk about absolute and relative terms in terms of poverty. When we talk about absolute terms, we're talking about the count of the number of people in the United States who are at or below the poverty line. When we talk about absolute terms, there are more white Americans in poverty than anyone else. That shouldn't be surprising because America has a majority of whites in America. So when we start to look at counts, we have more whites than anyone else. However, when we start thinking in terms of relative poverty, things change a little bit. Relative poverty is if you look at, for example, white, if you look at any given white and say, okay, well, how many or what percentage of whites are in poverty, it's only 11.6%. When we talk about African Americans, 24.1% of all African Americans living in the United States are living in poverty. Because there are less African Americans, they don't rank number 1 in terms of absolute poverty, but they rank number 1 in terms of relative poverty. Also, in terms of poverty, there's a greater percentage of families headed by females. That shouldn't surprise us because we know there's some wage discrimination with women. And also families with 7 or more, larger families, tend to have more poverty. This is accurate as of 2015. Do we think poverty is okay or income inequality is okay? Well, this becomes a really normative statement. In the beginning of the semester, we talked about positive, which were statements of fact, and normative, which were statements of judgment. This is really a statement of judgment. Do you think that's okay or not? John Rawls, who was a philosopher, talked about saying you need to have a veil of ignorance. You can't answer that question because you already know your outcome. Even if you're poor, you're in the United States, which is one of the wealthiest countries in the world. So you need to think about, what if you were with your maker and before you knew you were going to be in the US being educated, right? You're in the top 1% of the world in education, even at a community college or tech college level. Is that okay? Would you have allowed for this inequality if you didn't know that you were going to end up in a rich country? So that becomes a moral argument. Then there's the economic argument about income inequality. And the idea basically goes, think about the marginal utility. As you consume anything more and more, the marginal utility declines. That's the law of diminishing marginal utility. So what if we took $1 million away from Bill Gates and gave it to you? Would your utility of that $1 million be more than his utility of that $1 million? And while it's really easy for us to hypothesize that Bill Gates may not even notice that $1 million gone, and I'm willing to bet that you or I would definitely notice $1 million in our bank account, remember, utility is not comparable across people. We think that that would be an improvement in overall utility across people, but we don't know. And if we force that transfer, what would be the consequence long term? So would we have impacted people's incentive to try and make that money and improve the market and improve the world? We just don't know. So this becomes a very normative argument. There's not a right or a wrong. Everyone has their feelings on this. But what we need to do is, if we're going to be talking about it, we need to know what the situation really is and what we think the consequences are of changing it or impacting it. Finally, the last topic is compensating differentials. So pretend for a second you live in a world where three things are true. All workers can do any job they want. So a garbage man can become the brain surgeon can become the garbage man. All jobs are equally attractive. So if you go out to the bar and see an attractive person, you can say, I'm a garbage man or I'm a neurologist, and everyone says, okay, cool. And labor markets are perfectly competitive. What's got to be true of the wages in this case? The wages have to be exactly equal. Why? Because if one started paying more, people would leave the market that was paying less and go to the market that was paying more, increasing the supply, driving the price back down. If they were ever off, people would switch from one market to the other. If that's the case, what would happen if we started to make jobs not equally attractive? So think about a call center job, and there's a day shift and a night shift. No one wants to work the night. The supply is going to be down. Anytime you make things less attractive, you have to pay people more. Anytime you make things harder for supply, so becoming a neurologist or a brain surgeon is a lot harder. It takes a lot more years of education. When that occurs, what happens? People have to get compensated for spending all that time in education. That's called a compensating differential. And that's one reason why we understand why people are getting paid differently.